Good afternoon, everybody. Today is Friday. It's the 20th of September, 2013, and we have the market closed here for the week. So let's take a look at the numbers first. You can see I'm pointed out on the S&P 500 that today's close of 170.72 shows as down $2.04 from Thursday's close. But if you look down below here, we saw the S&P 500 trade ex-dividend today. So 84 cents was taken out. If you put that dividend back in, basically, for chart purposes, it would have made the close at 171.56, and that's going to be important, as we'll see in just a moment when we look at the 5-day moving average. That really puts our close, considering the dividend. Now, this is kind of made up world because the dividend did get paid out, but the point is that with today's close, our 5-day moving average, we did actually close above it on adjusted for the dividend basis. So there's no doubt, though, that the market underwent some selling pressure today. We were underneath the volume-weighted average price for almost the entire session here. But for the week, we did still, even with that dividend, show that prices advanced 0.82%. For the NASDAQ, 1.2%. Russell 2000, 1.7%. Semiconductors, 1.5%. Oil got hit, and the dollar got hit as well. So let's take a look at some of these charts, and let's start again with the S&P 500. We had a breakout beyond the highs that we had seen earlier in this year, and that is just a couple months ago. And we're kind of right at the top end of that range. If you look at a trend line, they're meant to be drawn in to capture the essence of the trend, not necessarily every little tick above or below. So we're basically at that top end of this trend line, of this channel that we've kind of been involved in, and pulling back right now. So when we look at a 30-minute time frame, this market has gotten pretty extended, and I think that after the news came out from the Federal Reserve on Thursday, you can see that the volume-weighted average price from that event was up here at about 172.37. So we've got the S&P 500 has given back the gains from the Fed, basically, and we've got this market up at multi-year highs. So there's clearly nothing to be bearish about. The longer-term trend is still higher, and that trend remains intact. Next week, what we're going to do is want to keep an eye on some of these key levels below 170, really down to about 169 and a quarter. I wouldn't be surprised to see us come down a little bit in towards that range, just to work off some of this little seemingly overbought right now. If we take a look at Fibonacci and the height of this, what we can see is that since the recent low back in late August to the recent high, that a 38.2% retracement would take us down right to almost close that gap in that 169 level. So 169 seems like a reasonable place for this market to pull back to, and certainly that would do some damage to some stocks if you're continuing to hold long. And it depends on what time frame you decide to get involved in. As I always talk from a swing trader standpoint, but I'm mindful not to fight it from a longer term trend. That if we have a longer term trend still higher, I will do swing trades on the short side, not necessarily in the S&P 500, but in individual stocks if the market indicates that's the proper thing to do. And short sales have been extremely difficult for most of this year. In fact, we've got great performance numbers for the year so far, up close to 20% for the S&P 500 and north of 20% for the NASDAQ, the financials, the semiconductors, and all those markets we look at. So we've got a great year, and just like any pullback that's beginning after a breakout, after these breakouts, we often get these pullbacks, and we're going to have to monitor how it pulls back and say what levels are going to be important for it. So initially, at the beginning of next week, we'll look for about 169 and a quarter or so, and then we'll kind of see, if it comes down to there. I think one scenario is maybe we get a bounce on Monday and then create a lower high and come down and test that. That certainly is a possibility. But more than anything, what I've been doing and encouraging subscribers at Alphatrends to do is to stay focused on the action in the individual stocks, because that's where the real opportunities are, and that's where you can best manage your risk. That is, you don't get freaked out every time the market sells off a little bit, but you listen to the message of the stock. And from a swing trading standpoint, we'll go through some of the stops that got hit this week and some lessons that were to be learned. The NASDAQ 100 is still riding its trend line and its rising 5-day moving average. We had a little bit of prior resistance, really down at about $78.30. I wouldn't be so surprised to see that tested next week, and maybe we get a little rally and then further downside. But don't lose sight of the fact that this trend in the market is still higher. There is no reason to be short in this market. What you want to do is when you have the feeling that the market is correcting or maybe in jeopardy of, if it loses a support level such as 78.30, then we want to get more defensive, and we don't necessarily want to pick a top in the market or say that the market trend is over, but we want to let those stops get hit in our individual stocks, stand aside. You can scalp obviously from the short side, that is short-term trade, very short-term intraday shorts. But with the path of least resistance higher, we want to be looking for the low risk, high probability trades to the long side still. The Russell 2000 was down 39 cents today, still clearly riding this trend line and the rising 5-day moving average. 106 is going to be an important level next week. And again, these are scenarios that if we maybe bounce up and then come back down, that we could undergo a little bit further selling pressure. But right now, there's no evidence from the market itself that these markets are correcting anything more than a 1 or 2 day pullback. But after the magnitude of the rallies that we've just experienced, we have to look at it and say it would be normal and expected to see this market digest the gains by either trading sideways through time and not giving up much in terms of price, or it would correct price-wise. And obviously the danger of price-wise is that you would begin to get stopped out of stocks, but it's a good cleansing process. It allows us to focus on new setups and low-risk trades that may reveal themselves to us after such a correction would ensue. The semiconductors have had a great rally here over the last 3 weeks. As we know, they broke down. We were very cautious under 38. As the buyers regained control, we turned positive on these, and still the trend is higher here. We're riding a rising 5-day moving average with a pattern of higher highs and higher lows. If we break below $40 a share, then I think that we would start to see the potential for a deeper retracement, only a pullback, because with the primary trend higher, it's innocent till proven guilty too. It takes a lot to change that type of trend. So we would look for what are normal places we would expect to find support. We wouldn't necessarily look to buy at those perceived levels of support, but say here's the potential levels. Let's just go back to that 30-minute time frame and say a potential level of pullback would be maybe 39.20. So we wouldn't want to buy at 39.20. Instead, we would want to look to that level and say now's the time to start looking a little bit more carefully to see if the buyers are in fact gaining control. What we want to do is we don't want to focus on the key exact level and try to pick the turning point. We're not trying to be precise. We're trying to get involved in a portion of the trend. If we can capture, a portion, this part of the trend, we've done a great job. And then avoid a pullback. That's what the ideal swing trade is all about. $20.20 is a level we've been focused on in the financials for a bit, and right now that's approximately where we see the 50-day moving average as well. This market has also probably gotten a little bit ahead of itself here, and a pullback down towards that level would not be unreasonable. I think that very short term, the last 2 days, we've pulled back a little bit deeper than maybe the market should, and we get a little bit of a bounce and then break the 2040 level and come down towards $20.20. We could look at similar Fibonacci in here and say if we do see that pullback scenario unfold, that maybe we get a 50% retracement down to 20 and a dime. Either way, 20 and a dime to $20.20. This should be a key band of support that we hold up next week, and we'll want to measure the health of the market based on how it holds these levels of support. Apple had an interesting week here. It was kind of all over the place. In what I have had drawn in there, and let's just take a look at it together, the volume weighted average price since the product announcement, that is since the day after the product announcement, and it gapped lower, you can see here the volume weighted average price we came right down to today. So today we gapped higher. We gapped higher 3 days in a row, and then today, so here 1, 2, 3 gaps in a row, and then today we sold off and right down to the volume weighted average price since that event. We also have this 5-day moving average just below us, and we can see that support here became resistance. Now the question is, will we find support in here next week at about 464? Looking at a 30, well, actually, let's look at a daily time frame. We had seen earlier in the week that close to that volume weighted average price is where this market reversed and headed higher from. And then from the June low, now we're right back up to the volume weighted average price of that, which is pretty interesting as well. So I think that this 465-ish area is going to be a pretty good little battleground for the next week or so. And if it holds, then I think we probably head up towards 485. But realistically, Apple is in need, I think, of still some healing in here and some more time kind of bouncing around down in this area. So let's take a look at a couple of names that I had mentioned in a video Thursday night, and then followed up on Friday midday on Alphatrends. Eagle was a stock that I wanted to mention this not because it was a great winner, but because of some things that, you know, I typically don't want to chase stocks on a gap, and that's something I tell subscribers all the time. Don't chase the gap right here. So it gapped higher on Wednesday. You can see that, or actually we bought it on Thursday, and it gapped higher on Thursday right on this day, and I suggested don't chase it. Instead, what we wanted to do, and we'll look at the 2-day price, was wait for that pullback to kind of the buyers regain control as it gets above the volume weighted average price, and then set our stop underneath the low of the day. And what we had done was raised our stop up to this area and got stopped out. And you know, the stock continued to move higher, but it was a good trade, and a lot of people would have missed it if they hadn't, you know, if they had chased that stop. The open, it would have worked. But the better entry was right here because we could have, and we were able to, in fact, manage our risk better. Now, two other stocks I wanted to talk about. I'm always a big believer in taking partial profits. Now, AK Steel has been in a long-term downtrend. I typically don't like to trade these stocks. That is the call it a natural resource or whatever you want to call it, commodity. But we got involved in it on Tuesday, I guess, at $4.05 a share. I always say, you know, our stop was at that point at $3.95. So we were looking at if it got below the higher low, we were going to take it off. So that was 10 cents away. So I said, listen, if we get a 10-cent rally, we're going to take half of it off. So we had half of it off at $4.15. We raised our stop at this point, and then we raised it again overnight on Thursday. However, when the stock gapped down on Friday, what happened was I said, you know, basically you want to rip the Band-Aid. There's two ways to trade this. You can either stick around with it and see if it holds VWAP and set your stop under there. If so, your stop right now would be 405. But I'd mentioned that my preferred way would be just to rip the Band-Aid and get out of it right there at the open. So at $3.96, I have us as selling the balance of that position. So we were involved at 405, and we got half of the profit, half of the stock off with a 10-cent gain, and then we got out of the rest with a 10-cent loss, so we didn't lose anything at all. And that wouldn't have been possible if we hadn't sold some initially into the initial strength. That also happened with another stock, Triple D. Now, Triple D, as you know, is the 3D printing company. It's got a great-looking chart, a big short position. It's arguably overextended, and it's, you know, certainly been a volatile battleground in here as the shorts are trying to, you know, hold this thing back and prevent it from being a Tesla, I think. But what we had done was to purchase this stock on Thursday right as it crossed back above the volume weighted average price in here. In fact, I recorded the entry as $50.20. On Thursday, we sold half of the position, up 80 cents at $55 a share. And then what I suggested was a stop down here at $53.40. So our stop at $53.40 resulted in, so we sold half of it here at $54.80, and then the stock gapped down and continued lower, stopped us out of the rest of that position here with a 60-cent loss. So we took an 80-cent profit, on half of it, 60-cent loss on the other half, and that allowed us to still come out on average 10 cents ahead per share. Now, you don't want to trade a stock like Triple D for 10 cents, but I don't think you want to be involved in it when the momentum turns back lower. Theoretically, we're at a level where we should see some support, but I don't trade on theoreticals. I trade on what price action is saying, and it tells me that the stock looks like it needs to consolidate a little bit further. We can always get back involved in it, but these are some of the concepts that I teach about having a consistent methodology each and every day at Alphatrends. So here's the plug. If you haven't taken a look at it at Alphatrends, do so. If you're reluctant to sign up for the trial, then I would say go to alphatrends.net and take a look at the video I posted Thursday night to give you an idea of how the stocks are presented for trading the next day, and then look at the follow-up video from midday on Friday. And keep in mind that there's a chat room open all day long as well, where I help subscribers kind of manage their day trades or ask other questions about the stocks that we've been involved in or stocks that they want me to take a look at. And if you're reluctant to put a credit card in, then it tells me you don't take it seriously, and you're probably just looking for a free trial, and you have 25 different email accounts you were looking to do that under. So no one's had a problem with getting their trial canceled, and if you don't do it on time, I will make sure you get it refunded. So you got nothing to lose. Take a look and start to learn and profit from a consistent methodology. Thanks for tuning in. Hope you have a good weekend.